Opinion on the moves Disney is making. Is it in their best interest to sell their stake in Hulu?
Well, I'll tell you, we want to get that balance sheet fixed. But can I just say, and I'm doing this series on undervaluation and how people say, am I too negative? This stock is now, it's just plain out ridiculous at 100. I'm just going to put it out. It's just ridiculous. It makes no sense to anyone I know, except for the sellers who constantly sell. If they walked away, which they should, I think that they realize that they are missing the boat. But they won't. Maybe we have to wait till everyone's done. Disney's a buy. Let's go. My Travel Trust owns it.
Why I will buy more Disney stock at this price.
Good day, subscribers. Thank you so much for joining me today. And today we're going to look at Apple possibly buying out Disney.
The key point is 100 years for Disney at the top of its game, almost no change in strategy or execution excellence. Apple has an iPhone that's 10 years old. So, and I think technology is not a moat, as evidenced by the fact that 11 years ago, Apple was 4% of the market. And as of the fourth quarter, it was 24% of the market. And what it did to achieve that is put people out of business. Disney has a succession issue. We've been trying for 6 years to replace Bob Iger, who is fabulous, but he's 72. So if you can bring in Disney into Apple and keep all of its storytellers independent, but with a $90 billion a year free cash flow check coming from Apple, you elongate Apple's ability to survive because you just gave it a bigger competitive moat. You can only get Mickey Mouse on iOS devices would be amazing, I think, for Apple.
5 reasons why DIS stock is crashing. The whole Disney debacle baffles me.
Even Ariel's black now. Everybody's black.
Disney was a money printing machine. People loved Disney.
For the Travel Trust, buying Disney right here. I know you're buying ahead of earnings, but we forgot they make movies and people go to them. $400 million worth.
Doctor Strange 2 cracked the top 10 all time.
Look, I think that people are missing the fact that it's not a two-legged stool. It's not just the theme parks and ESPN. It has this movie division, and they're going to start coming out. Now, they did pay a lot of money for Fox, and that wasn't cheap. Right. $71 billion. Right. I want to see if there's a write-down this quarter.
But you're a buyer here.
Absolutely. Just put some for the trust.
Of Disney at 10.
Yes, right here.
They counted on it being an entertaining, easy, predictable, fun experience for their kids, and in some cases, even a good experience for the adults. Disney could not lose. Then this happened.
Now you watch Disney and you notice that a lot of Disney's, iconic characters, like most recently Snow White and the Seven Dwarfs. Look at the Seven Dwarfs now. Man, why is Ariel black? And why are the Seven Dwarves like all sorts of different races and all that crap? And why is Snow White a Latina? It's literally in her freaking name, White.
Disney DIS stock is now trading at its lowest level in 10 years, and it still may not be cheap at all. In this video, I will give you 5 core reasons why Disney stock may not be as cheap as it looks. At what price will you get a margin of safety on DIS stock? With everything happening around the kingdom of Hollywood.
I don't know if there's a lot of optimism out there. I mean, I would describe the sentiment on Disney stock as probably the worst it's been in 20 years. And it really has to do with big structural issues. What is the future of Hulu? What is the future of ESPN?
Is the Disney's moat still intact? Does Disney have a debt crisis? Why I will buy more Disney stock at this price. I will explain it all right after this.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video. Because you're already a success, it is done when you join the Audacious Money Witch Club. This video is brought to you by my website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to join the Audacious Money Witch Club, don't you? Reason number 1. Cord-cutting trends. Disney owns ABC Network. ABC has an 80% ownership in ESPN, which puts it under Disney's control as well. With cable subscriptions declining by almost $20 million since 2012, ABC and ESPN's viewership and ad revenue has been drastically decreasing. Reason number 2. Streaming service concerns. While the launch of Disney's streaming service, Disney Plus, was an initial growth catalyst, it now is being seen as a downside. Disney is still suffering big profit losses from its streaming business, and last quarter saw a decrease of almost 12 million subscribers. Current Disney Plus subscribers 146.1 million, down from 157.8 million. Reason number 3. Content delays and production challenges. The pandemic shutdown and writer strikes have caused ripple effects in the film industry. Movie and TV show production delays have created a content backlog, which limits Disney's ability to keep their audience engaged and paying. Reason number 4. Rising costs. Disney is facing a rapid increase in production costs for its content and theme parks. These big increases in operational costs are squeezing profit margins and drastically affecting their bottom line. It's also harder to forecast future revenue expectations. Reason number 5. Economic uncertainty, fears of a recession, and soaring inflation has average people living on a much tighter budget. Why is Disney's debt crisis scenario relevant? We had low rates for a very long period of time, which gave companies like Disney, Fox, and Marvel an incentive to take on debt. In August of 2023, Disney is downloaded with $47 billion in total debt. They only have $11 billion in cash. We know the Fed just raised interest rates at a rare and rapid rate to 5.33%, and they are still not done. If you've seen my last video about Foot Locker stock, I said we are already in a consumer recession. So how could a major recession occur like 2008 financial crisis? One possible scenario is that inflation remains higher than the Fed and the markets anticipate, and it does so for the next 3 years, forcing the Fed to hike further and keep rates higher for the next year or two, which impacts Disney's stock price and Disney's balance sheets. When the interest rates are higher, it will be much more difficult for Disney to roll over debt. That's a risk for DIS stockholders. Right now, Disney have total current assets of $29.09 billion. Its total current liability is at $29.07 billion. That's cutting it close. Some of its current asset is inventory. That's not easy to convert to cash in a consumer recession. This means Disney could potentially have debt refinancing issues. I found a Walt Disney Company bond has an annual yield of whopping 26.51%. It has a coupon of 4%. This bond was issued at 2019 with a volume of $284 million. It's about to mature at October 1st of 2023. This has created an uneasiness in future revenue expectations for Disney's theme parks and streaming service. Disney's stock, DIS, is now negative 58.4% from its all-time high. Economic challenges and increased costs of operation continue to cause major headwinds for the company. Bob Iger and Disney still have a lot of work to do, as they basically need to change their entire business model. Disney shares are now at the same price they were almost 10 years ago in 2014. If you invested in Disney in 2014, you would have made no money, and you would actually still be in a loss. In the same time frame, the stock market S&P 500 overall is up 300%. So does this mean that Disney stock is cheap now? Not quite. In fact, though right now Disney stock has the market cap $153 billion. It actually the same as 2014. However, its free cash flow and net income right now is far less than about $5 billion less than 2014 levels. In other words, because of the trend has shifted towards streaming, its legacy TV channels don't make as much cash as it used to. Because of lockdown 2020, people don't go to movie theaters that often anymore. This caused less investment into the creative side in these movies, which doesn't inspire more people to watch it, and viewers getting disappointed and decided not to go back to the theaters. This has created a reverse snowball effect, a death spiral for the broken storytelling machine. For some reason, share-based compensation and more shares was also issued compared to 2014. Because Disney CEO Bob Iger acquired Pixar from Apple, great move, Marvel and Lucasfilm, brilliant move, and $71 billion of 21st Century Fox in 2019, that's a bad one. I think he has paid too much. Buying Murdoch's studios undoubtedly allowed Disney to scoop up valuable franchises, including The Simpsons, Avatar, X-Men, Fantastic Four, and Deadpool, allowing those characters to join Disney's MCU. The National Geographic and FX cable channel also came with the deal. With all these assets, it also comes with all the liability, because when you're buying a company, you need to buy its debt as well. At the time, Wall Street was high on the future of streaming companies. Over and Murdoch had initially agreed on a $52.4 billion all-stock deal for Fox. But later, Iger found himself dragged into a bidding war by Comcast CEO Brian Roberts, who offered Murdoch considerably more money. To clinch the deal, Disney ultimately agreed to pay $71.3 billion. In addition, Disney took on nearly $14 billion of Fox debt. Even without Fox, Disney would still be struggling with linear channels and figuring out how to make streaming profitable. But they would be in a much better position financially without all these $47 billion of debt sitting on their balance sheet, and they would not have needed as big of a reorganization. On the bright side, Disney's purchase of Fox kept the asset, including the popular streaming service Hulu, out of the hands of Comcast. However, Comcast still owns 33% stake in Hulu, and Disney already committed to pay $9 billion for the remaining 33% in 2024. The reason why Disney stock is not as cheap as you think is because although the price is at a 10-year low, its free cash flow yield is at 1.79%. I mean 10-year yield is at 4.2%. That is a huge gap. If the Disney Plus is still losing money, the stock price has to come down to $40 a share to get a fair value on Disney stock in this high yield market. If you buy around 40, I think you will get a margin of safety price. Either the market cap of Disney has to come down another 50%, or it has to stop losing as much money on Disney Plus to boost the free cash flow number. Because stock price in the long term is based on math and numbers. If the math equation makes sense, the price follows. Now the question is, which part of Disney's business will Bob Iger sell off to buy the rest of Hulu? Is that going to be profitable for us as shareholders in the future? Based on the stock chart of Disney, if DIS stock broke through 79, the next stop will be at 72, then 70, 60. I will add more shares the lower it goes. Because there is no way Disney, with all these money printing assets, will end up being broke at the end. You are such a good boy for watching my video right till the end. Bye.